You have $1,000 saved up. Maybe it's an unexpected bonus, a tax refund, or money you've been setting aside. You want to invest it, but you don't want to lose it. The stock market feels unpredictable. Cryptocurrency seems like gambling. So what do you actually do? In the next 8 minutes, I'll show you exactly how to invest $1,000 right now for low-risk, steady returns. No hype, no gambling, just practical options that actually work. First, let's talk about what low risk actually means. Low risk doesn't mean no risk. It means your money is protected by the US government, FDIC insurance, or highly rated institutions. You won't get rich overnight, but you also won't wake up to find your investment has dropped 20%. The goal here is steady, predictable growth. Now, there's one question you need to answer before you do anything. How long can you leave this money alone? If you might need it within 1 to 3 years, your strategy should be different than if you can leave it for 5 years or more. For short-term money, you want capital preservation. For long-term money, you can take a little more risk. Let's start with the safest option, high-yield savings accounts. Right now, the best high-yield savings accounts are paying up to 4.50% APY. Some accounts even offer 5.0% under certain conditions. Compare that to the national average savings rate of about 0.40%. That's a massive difference. If you put your $1,000 in a high-yield savings account at 4.50%, you'd earn about $45 in interest over the course of a year. With a standard savings account, you'd earn about $4. The right account can turn even short-term savings into real earnings.
The second option is a certificate of deposit, or CD. A CD is like a savings account that locks your money in for a set period, usually 3 months to 5 years, in exchange for a higher interest rate. Right now, the best one-year CDs are paying 4% or higher. Some CDs are offering up to 4.50%. The trade-off is that you can't access your money until the term ends without paying a penalty. But if you know you won't need this $1,000 for a year, a CD is a great option. A one-year CD at 4% would earn you about $40 in interest. The best nationwide CD right now is offering 4.50% on a 5-month term. The third option is U.S. Treasury bonds, or T-bills. These are loans you make to the U.S. government, and they're backed by the full faith and credit of the United States. They're one of the safest investments in the world. Right now, U.S. Treasuries are offering top rates of 4.87%. The minimum investment is only $100, so your $1,000 can be spread across multiple T-bills. T-bills also have a tax advantage. The interest is exempt from state and local taxes. On a $1,000 investment at 4.87%, you'd earn about $48.70 in a year.
The fourth option is a short-term bond ETF. These are funds that invest in bonds that mature in 1 to 3 years, making them less volatile than traditional bond funds. They offer a low-risk way to park cash and earn a modest yield. For example, the Vanguard Short-Term Bond ETF, BSV, charges just 0.03% in fees and offers a 4.03% yield. The Schwab Short-Term U.S. Treasury ETF, SCHO, offers a 3.81% yield and focuses entirely on U.S. Treasuries, ensuring very low risk. These ETFs pay monthly distributions, making them useful for income-focused investors. They're also more liquid than CDs or individual bonds. You can sell them at any time. Now, what if you can leave this money alone for 5 years or more? You have another option, a low-cost total market index fund. This is what many financial experts recommend for long-term investors. These funds own tiny pieces of thousands of companies, providing instant diversification and requiring zero ongoing work. They've historically returned about 7 to 10% per year over the long term. But here's the catch. They can go down in the short term. If you might need this money in the next few years, this is not the right choice. But if you can let it sit and grow, index funds are a powerful wealth-building tool.
Let me give you a real-world example of how this could work. You could put $500 in a high-yield savings account for easy access and $500 in a one-year CD at 4% to earn a guaranteed return. That gives you both liquidity and growth. Or you could put the full $1,000 in a short-term bond ETF like BSV, earning about 4% with monthly distributions and the ability to sell anytime. Or if you're thinking long-term, you could put the full $1,000 in a total market index fund like VTI and let it ride. Now, a few important warnings. First, always check the fees. If you're buying an ETF, look for an expense ratio of less than 0.10%. The difference between a 0.03% fee and a 1% fee might not seem like much, but over time it adds up. Second, make sure your money is protected. For savings accounts and CDs, make sure the bank is FDIC insured. For treasuries, you're backed by the US government. For ETFs, you're investing in a fund that holds actual assets. Third, understand what you're buying. Don't invest in anything you don't understand. If you can't explain it to a friend, don't buy it.
Let's do the math. If you put $1,000 in a high-yield savings account at 4.50%, you'd earn $45 in 1 year. In a 1-year CD at 4%, you'd earn $40. In a T-bill at 4.87%, you'd earn about $48.70. In a short-term bond ETF at 4%, you'd earn about $40 with monthly payments. In a total market index fund, historically, you'd average $70 to $100 per year over the long term, but with some years being down. So, what's the best choice? It depends on your timeline and your comfort level. If you might need the money in the next year, stick with a high-yield savings account or a short-term CD. If you can leave it for a few years, consider T-bills or a short-term bond ETF. If you can leave it for 5 years or more, a total market index fund is worth considering. Your action plan for today. Decide on your timeline. Then, open a high-yield savings account at an online bank if you don't already have one. Compare rates at sites like Investopedia or Bankrate. And remember, the best time to start investing was yesterday. The second best time is today. Thank you for watching. Subscribe for more practical money guides.